Global economic outlook, moderate growth, and a wide range of possibilities. The global economic outlook, according to Morgan Stanley research dated November 19, 2025, points toward moderate growth in the coming years. This growth is expected to be fueled primarily by resilient U.S. consumer spending and continued capital expenditures by businesses on artificial intelligence, AI, while simultaneously benefiting both from a global slowdown in inflation. Global economic expansion is projected to ease to an estimated 3% quarter-on-quarter annualized in 2025 and then stabilize at 3.2% in both 2026 and 2027. This stable, moderate pace is underpinned by robust consumption and business spending. Seth Carpenter, Morgan Stanley's chief global economist, noted that healthy household finances and rising wealth are keeping American consumers spending. While businesses continue to invest in AI, these two factors are why a recession was not forecast for early 2025. With the U.S. remaining the most likely engine to drive material upside for global growth. Regional growth and disinflation. Beyond the global figures, the U.S. economy is anticipated to slow, notably in the first half of 2026, before re-accelerating, aided by consumer and business momentum, alongside easier monetary policy. This is expected to result in real GDP growth of 1.8% in 2026 and 2.0% in 2027, with the growth potential picking up as AI adoption increases productivity. China's real GDP is forecast to expand by 5.0% in 2026, boosted by government policy support, before easing to 4.5% in 2027 as the fiscal stimulus wanes. Growth in the euro area is expected to remain moderate at 1.1% in 2026 and 1.3% in 2027. The disinflation trend is global. In the US, the core personal consumption expenditures, PCE, index is forecast to be 2.6% at the end of 2026 and 2.3% at the end of 2027. In the euro area, headline inflation is expected to undershoot the European Central Bank's ECB 2% target, running at 1.7% at the end of both 2026 and 2027. Monetary policy and rate cuts. The benign inflation picture will allow monetary policy to move toward neutral in key economies. The Federal Reserve is likely to reduce rates through April 2026, assuming job growth is slow and core inflation remains modest. The forecast expects a subsequent extended pause, with the target rate between 3% and 3.25%. Given slow growth and inflation below target, the ECB is forecast to implement 2 rate cuts in 2026, bringing their policy rate down to 1.5% by mid-year. The Bank of England is expected to bring rates down to 2.75% in 2026, before pausing. The Bank of Japan, which is still hiking rates, is expected to raise its policy rate to 0.75% in December 2025, remain on hold in 2026, and potentially resume hikes to 1.25% in 2027. Alternative scenarios. Uncertainty remains high, creating an unusually wide range of possibilities for global growth. Demand-driven upside. Stronger than expected spending by U.S. households and businesses could ramp up investments, pushing real U.S. GDP above 3% in 2026. Productivity-driven upside. If AI adoption accelerates and its impact on the economy occurs more quickly, the economy could grow faster than expected, even with low prices, stabilizing unemployment. Mild recession. Downside. A greater than expected slowing in the U.S. economy due to monetary policy lags or trade issues could cause quarter-on-quarter real GDP growth to turn negative in the first half of 2026. With a mild recession potentially rippling across Europe and Asia, the final outcome will depend on the resilience of the consumer and the timing of meaningful productivity gains from AI adoption.